Most founders believe seed investors are simply the first people willing to write a check. But experienced investors know that seed investing isn't about funding ideas, it's about validating futures. And misunderstanding that difference costs startups millions in lost opportunities, failed fundraising rounds, and stalled growth. Every year, thousands of startups attempt to raise seed funding, yet only a small percentage succeed. Not because their ideas are bad, but because they don't understand how seed investors actually think. Seed investors operate at the intersection of extreme uncertainty, massive potential, strategic validation. They are not buying revenue, they are not buying traction, they are buying signals of a future company. Signals that most founders don't even realize they are sending. Today we break down what seed investors really are, what they actually evaluate, and why understanding their mindset can dramatically change your startup's trajectory. Seed investors operate at the earliest stage of the startup lifecycle, before scale, before significant revenue, often before a full product even exists. This stage typically comes after friends and family funding, but before Series A venture capital. Seed capital is used to transform an idea into a real company. It funds MVP development, early hiring, initial market testing, product refinement, early traction experiments. Seed investors usually include angel investors, seed venture funds, startup accelerators, early-stage venture capital firms, strategic angel syndicates. But what truly defines seed investing is risk tolerance. At this stage, the product may still be evolving, the market may still be uncertain, the business model may still be unproven. Seed investors are betting on potential energy, not proven momentum, which is why their evaluation framework is fundamentally different from later-stage investors. Seed investors do far more than inject capital. They validate the possibility of a company. When a credible seed investor backs a startup, several powerful signals are created. Signal number 1, market belief. It tells the market this idea has professional backing. Signal number 2, investor confidence. Future investors pay attention to who funded the seed round. Signal number 3, execution momentum. Seed capital enables startups to move faster, build products, hire talent, test markets. Iterate quickly. Without seed capital, many startups remain stuck in permanent prototype mode. But seed investment also carries consequences. Seed investors typically receive equity ownership, which means they are long-term partners, strategic influencers, governance participants. And if founders misunderstand how this stage works, they often damage their cap table, their valuation trajectory, their long-term control. Understanding seed investors is therefore not optional. It's structural to building a scalable company. Seed investors don't ask one simple question, is this idea good? Instead, they analyze 5 fundamental signals. Founder capability. The founding team is the single biggest predictor of early-stage success. Investors ask, can these founders execute? Can they adapt under pressure? Can they recruit talent? A strong founder team often outweighs a perfect idea. 2, market size. Investors look for large, addressable markets. Why? Because venture investing depends on outlier outcomes. If a startup can't realistically become a $100+ company, it struggles to fit venture economics. 3, problem intensity. Seed investors love painful problems. If customers feel real pain, they will adopt solutions faster. Weak problems create weak startups. 4, early signals. Even before traction, investors look for indicators, early user engagement, prototype testing, customer interviews, pre-orders, community interest. These signals show momentum potential. Defensibility. Investors ask, what prevents competitors from copying this? Defensibility can include network effects, proprietary data, technology advantages, unique positioning, brand momentum. These signals collectively determine whether investors lean in or walk away silently. Many founders approach seed funding with dangerous misconceptions. Myth 1, it's about the idea. Ideas matter, but execution matters far more. Investors fund teams capable of building companies, not just ideas. Myth 2, pitch decks win funding. A great pitch helps, but investors fund evidence of thinking, not presentation slides. They look for market insight, structured strategy, clear positioning. Myth 3. The first check is all that matters. The quality of the first investor can shape future fundraising. A respected seed investor creates credibility, investor signaling, faster follow-on rounds. Myth 4. Funding solves everything. Funding amplifies strategy. If strategy is weak, funding simply accelerates failure. The best founders raise capital after building clarity. Before approaching seed investors, founders should pressure test their startup using 4 strategic lenses. Idea validation. Ask, does the problem truly exist? Who experiences it most intensely? How are they solving it today? Strong startups begin with validated problems. 2. Feasibility analysis. Evaluate technical feasibility, operational complexity, market adoption barriers. Not every good idea is practically executable. 3. MVP strategy. Your MVP should answer one question: will people actually use this? Seed investors want to see learning velocity, not perfect products. Strategic roadmap. Investors want clarity on next milestones, hiring plans, product evolution, revenue strategy. A strong roadmap signals strategic thinking. Consider 2 hypothetical startups. Startup A. The founders build a product based purely on their own assumptions. They raise seed funding quickly, but within 18 months, customer adoption stalls. Product market fit never arrives. Investors lose confidence. The startup shuts down. Startup B. The founders spend months validating their problem. They interview customers, test prototypes, refine positioning. When they approach investors, they present market insights, customer evidence, a structured roadmap. Their seed round closes quickly. Within 3 years, they raise Series A funding. The difference? Strategic preparation. Elite founders understand something deeper about seed investors. Seed funding is not just capital, it's signal architecture. Who invests early influences, future venture rounds, board composition, strategic direction, exit pathways. The wrong investor can slow growth. The right investor can open doors to talent, partnerships, customers, later stage capital. This is why experienced founders choose investors carefully, not just checks. Seed rounds shape the DNA of the company. Seed investors operate at the most uncertain stage of company building. They are betting on founders, markets, signals, momentum potential. Understanding their perspective changes how founders approach product development, validation, strategy, fundraising. The most successful startups don't chase investors. They build investable companies. At MP Nerds, we believe startups succeed when ideas become structured businesses. We help founders move beyond inspiration into execution through idea validation and feasibility analysis, strategic business roadmaps, MVP development planning, market positioning and investor readiness. Because investors don't fund ideas, they fund clarity, strategy, and momentum. If you're building something ambitious, the earlier you structure your thinking, the stronger your company becomes. Let us know in the comments. What startup topic should we break down next? And if you want more insights on building investable startups, subscribe to MP Nerds.